US Treasury market. The U.S. Commerce Department's Bureau of Economic Analysis reported on January 27 that the latest GDP slowdown for the fourth quarter of 2022 was less than expected, and initial jobless claims hit a 9-month low, making the Federal Reserve resolute in its resolve to continue raising interest rates to combat inflation. However, it also indicates that U.S. borrowing costs will continue to climb, adding debt servicing pressure to the currently volatile U.S. bond market. The Fed's Favored Expenditures Price Index also dropped to 3.2% year-over-year rise. However, a study conducted by S&P on January 26 revealed that inflationary pressures in the United States surged for the first time since March of last year. In addition, the preliminary composite PMI for the markets revealed that input costs increased for the first time since May 2022. The most recent economic data resulting in increased selling pressure. How about U.S. debt ceiling? In the meantime, a newly reported gauge of domestic demand on January 27 expanded at the slowest rate in over 2.5 years, showing the rising cost of servicing U.S. debt. While the potential of a change to tightening by the Bank of Japan has kept European and Japanese investors away from the U.S. Treasury market, thereby increasing the cost of their hedging. Since 8 block orders for 10-year U.S. Treasury futures totaling $6.8 billion have been sold, marking the beginning of a persistent short of U.S. Treasury. The U.S. Commodity Futures Trading Commission said on January 26 that the net short position of hedge funds in U.S. 10-year Treasuries hit its highest levels since December 2019 last week. In the preceding 4 weeks, net capital outflows from the U.S. Treasury market increased to $38.6 billion. The worldwide selling of U.S. Treasury securities is adjusted for monthly inflation figures. This has driven the nominal yield on U.S. Treasuries into a more negative territory. A negative real yield indicates that investors lose money when they purchase monthly inflation-adjusted U.S. Treasuries. All overseas holders of U.S. Treasuries, including Japan, China, the United Kingdom, and others, may be required to pay a retroactive interest rate to the U.S. Treasury. International Capital Flows report published by the U.S. Treasury on January 19, global central banks sold U.S. Treasuries for the 10th consecutive month, with holdings falling to $7.27 trillion, the lowest level in over 2.5 years. China continued its substantial sales of U.S. Treasuries for the 3rd consecutive month. In the 3 months ending in November 2022, the country's holdings of U.S. Treasuries dropped from $101.8 billion to $87 billion, representing a 12-year low. China has sold up to 20% of its U.S. Treasuries on a net basis for a total of $210.8 billion since November 2021. China's holdings of U.S. Treasury securities have fallen below $1 trillion for 7 consecutive months. There is a 2-month delay between the release of the official U.S. Treasury position report and its publication. Given the high fluctuation of the yield on 10-year U.S. Treasury notes, the following 2 months of the report could include additional data on central banks selling assets. A report published by the World Gold Council on the 25th best explains this. According to the paper, the use of the dollar by the United States as a tool to limit the settlement of financial and commodity transactions in other nations will force global investors in U.S. Treasuries to cut or abandon their holdings. And gold, as a strategic commodity, will play a significant role during periods of volatile financial asset prices. In the first 11 months of 2022, according to the most recent data from the 2019, when China claimed no increase in its gold reserves, at least 3,210 tons of gold have come in batches from the US, the UK, Europe, and other key gold markets during the past 4 years, some of which may have been converted into gold reserves. During this time period, China lowered its holdings of U.S. Treasury securities by $210.8 billion. International reserve assets exhibit a clear tendency toward U.S. debt risk. The dollar's position on the currency markets will be reevaluated. At that time, the dollar's position will be severely weakened. Thank you for watching the video. Please subscribe.